Hello, friends. It's so
Well,
good to
hey,
see
we
all
are
of you.
we are live, aren't we?
Yes. Hey, everybody. Here with Jason. Jason is a multi-talented individual. He is getting all the slides ready. We are extremely efficient and professional, and Jason is making sure the slides are just perfect because we want the presentation to be very educational and inspiring and
We're
motivating
working on it.
to each of you. Yes. So
So, everybody, it has been a while since we've been live on Sunday night, and we're glad to be back with you. And Evan, thanks for joining me. Tell us what you want to talk about today. And, the title gives it away. But the question is, could the stock market ever beat income property?
Well, anything's possible, but it's highly unlikely. I mean, as you know, as an economist, you always talk in probabilities, and nothing is absolutely impossible. But given history and given the extraordinary advantages of income property, it's very unlikely if you follow our strategy, especially.
It is the most historically proven asset class in the entire world, no question about that. Give us a little insight into this discussion as I kind of get these slides queued up for you, Evan.
Well, there's a couple of things. There's a couple of reasons I thought we should talk about this today. First of all, is we have seen so much attention to the stock market recently, with the whole GameStop Reddit phenomenon that you've talked about on the podcast.
Wall Street bets, yes.
Yeah. I mean, so there's just a lot of attention. There's probably some serious change going on in the stock market. I mean, you've always said that Wall Street is the legal version of organized crime, or the
modern version, yes.
Yeah, but it's legal too. I mean, so it's the modern legal version of organized crime. And maybe that's going to change a little bit because it's always been an insider's game. That was another thing I learned from you I talked to a lot of our clients, and a lot of them have invested in the stock market before, and they're like, well, where's the money? The market's gone up, and I put in, the max plus the matching, and it still doesn't feel like very much. And that's true because it's the insiders who really profit.
Right. Yeah, it is an insider's game, no question about it. And you know who's super famous in the hedge fund world now, or really ETF world, I guess I should say, is Cathie Wood with ARK Invest, and she's making a lot of news. And it's interesting because I saw a video this afternoon about how someone really dressed her down and kind of showed the fallacies in her pitch and her track record before, and the track record of her people at ARK. Now, I'm not saying that's true or not, because I've been really interested in Cathie Wood's message too. But the point is that no matter what happens, the fund manager always makes money, and not just a little bit of money, a lot of money, because of the way the game is structured.
Kind of like the syndicator, right?
Right. Syndicators and real estate deals, same thing. Absolutely. But Evan, what's interesting about it is when the pitch, and this is particularly true of Cathie Wood and ARK, when the pitch is, look, these are big, mega disruptive innovations, right? They're big things that are going to change society. They're going to change the world, the future technologies. And when it's those things, the pitch is that investors may have to wait a long time for their return. And as they're waiting, the fund manager just racks up profits and profits and profits and says, look, these are big, giant disruptive innovations, genomics, blockchain, whatever it is, right? Autonomous vehicles. It takes a long time to get there before you see the profits in this stuff, in biotech, whatever. And so that's sort of particularly an ARK thing that they can take advantage of, that they can really exploit, So,
yeah. I mean, it is. I'm sure she's brilliant, and I'm sure she's, I know she's gotten great returns for investors, but it's starting to feel a little bit like a mania with her, with the ARK fund. When you start to see them everywhere after 1 year of huge performance, that raises my concerns.
Yeah, absolutely. Well, good stuff. Let's go ahead and dive into this now that we are all ready. And Evan, can you just tilt your monitor down a little bit?
Yeah.
Okay, good. So first off, if you need to reach us, jasonhartman.com, or in the US, you can call us at 1-800-HARTMAN. And a funny little piece of trivia here, Evan, you're so informed on the news and you always, follow every story. You're a voracious reader. But the famous Wall Street Bull, the sculptor who created this just passed away. And what I was amazed to learn about this is just a little trivia here, folks, before we get into the meat of today's topic. What I was amazed to learn is that this was originally a gag, a $350,000 prank. That's what this is, right? And so here's the story, okay? Intended as a joke, it became a cursedly serious thing, right? The artist behind the Wall Street Bull has died. And it says here that he sculpted the charging bull, right? The bronze statue in New York, which became the iconic symbol of Wall Street. Okay. And he lived in New York, I guess, for like 40 years. He moved back to Sicily, which is where he's from. And that's where he passed away. But what did I want to tell you here? This is the interesting thing. The artist reportedly spent $350,000 of his own money to create a 3.5-ton bronze beast that came to symbolize the resilience of the U.S. economy after the 1987 stock market crash. So he put it there. He got a crane and he just left it there. That's an amazing story. It really is.
Isn't there one in Shanghai too?
I do not know. I don't know. Yeah.
I thought I remember that was like a big deal when in Shanghai they unveiled the charging bull in front of their stock exchange.
Well, that's so interesting that you mentioned that because I did a presentation in Miami at the Fontainebleau Hotel just about 2 weeks ago now. And one of the questions I got after the presentation was, sort of, I don't know the exact question from the audience, but the gentleman was asking about China and what were my thoughts about the competition between the US and China. And I said that I was interestingly more concerned about China in the near term than the long term. And what I mean by that is, look, I think the next 10 years for China are probably going to be pretty impressive, as have been the past 20 years. But after that, China has very, very serious demographic problems. And also democratic problems. I almost stumbled and said democratic. Yeah. They've got both problems. And the one-child policy just worked very well in China. And they are on the verge of a demographic cliff. And so I am not worried about or impressed with China in the long term. In the near term, yes, communism is pretty darn efficient. They're doing a lot of things tech-wise that are pretty impressive. Obviously, the building, the construction, but there are a lot of cracks in the facade of the Chinese miracle. Okay, folks. So do not be too concerned.
You know, when I look at that bull, it's such a great work of art, and I love the symbolism of sort of capitalism and creativity, and what John Maynard Keynes called the animal spirits that animate capitalism. But one of the things you've taught me is that Wall Street isn't really capitalism. No. Wall Street is crony capitalism.
Yeah.
Real capitalism are the small business owners. That's where the competition is real. The idea is beautiful, but where it's placed doesn't really fit.
Right. Wall Street probably in the old days used to be capitalism, real capitalism. But in today's world, yeah, you're absolutely right. It's just cronyism. It's really what's interesting, especially with the Biden administration. And I'm not like getting all political here, so don't tune out. Okay. what we're looking at is a version, and Obama was this way too, Trump less so, and in some ways because he was so hated by the corporatocracy, he just sort of went against everybody except the American worker and his idea of America, which was more insular and really, I mean, there's a lot of good reasons for Trumpism, and Trump was a very looking back on it, I guess, predictable reaction to what was going on. And it will be another pendulum swing back after the Biden. But what we have is this version of what I'll call socio-fascism. And we certainly had that under the Obama regime. And you can see that already with Biden. Look at the way the corporatocracy is just infiltrated the cabinet, and not just the cabinet, but the czars and just everybody that these two administrations, Biden and Obama, have connected with. So it's like a corporate takeover. At the same time, more movement toward the left side of the political spectrum, the socialist side. So socio-fascism, that's what I'm calling it.
And that makes sense. Yeah. I like that. That's a very good term.
And speaking of that, Evan, California. Wow.
We love to pick on your home state. I'm not from there, so I don't have that.
Let me tell you, just when you thought it couldn't get any worse, California is, and the reason some of you may be thinking, by the way, post your location in the comments and tell us where you're watching from. I know you're on Facebook and YouTube. Just quickly write, what city are you in? Where are you located? In the US, around the world, whatever. But the reason California is so important is because, what is this? The 5th or 6th largest economy in the world. If it were a country, it would be part of the G7, right? Oh, and it's a giant economy. It's the biggest state in the US. It tends to be a trendsetter. Hopefully not in this case. California has so many new ideas right now in ways to tax people. Well, here's another one. So now they want to do an excise tax on property owners in California who are renting or leasing property. So if you are a landlord in California, here is another reason for you to immediately run, not walk. Well, run with your fingers, okay, like this. Run, okay, to jasonhartman.com and reach out to us, or let your fingers do the dialing, as the old saying goes, to 1-800-HARTMAN, and talk with one of our investment counselors like Evan, or any of the other team members, because you need to do a 1031 tax-deferred exchange and sell your California income properties and diversify those properties into other more landlord-friendly, more business-friendly states. This is not just a single hit here, okay?
I was just talking to an investor. I was talking to a client on Friday that has 3 or 4 single-family rentals in California. They're cash flowing for him. He's done quite well with him, but he thinks the exact same thing.
Well, they're only cash flowing because he's got too much equity.
Yeah, well, of course I told him that. You know I did.
Okay.
But he's done well with them. They've appreciated nicely, but he realizes that he could get so much more cash flow if he sold those properties or 1031 them and got several in Memphis or Alabama. And he would be safer too. He'd be more diversified because he's got his beautiful primary residence in California, which has done well for him. And then he can have these other rental properties in at least 3 different markets, but not more than 5. Yeah. And he can do well with them.
Right. And the reason Evan says that is because that's what we say. Diversify, take the most historically proven asset class, income property, but diversify geographically. So you should be in at least 3 markets, but not more than 5. So thank you for bringing that up, Evan. So this is a double hit. Okay. So first off, you've got so many things California is trying to do. Now, it didn't succeed on everything in the last election, but mark my words, folks, once it gets out there into the ether, it does not go away. That'll be back on the next ballot. They are going to end Prop 13, which means property taxes will go up in extraordinary ways. They will win on that at some point. They have to. They're broke. California is a fiscal disaster. And then Joe Biden at the federal level wants to do away with the 1031 tax deferred exchange. So many of our clients, including yours truly, I am a client of my own company, I want you to know, they are repositioning their portfolios and doing 1031 exchanges in fear that it may be the last chance if Biden takes away the 1031 tax deferred exchange. Now, he may not be able to pull that off. I'm not sure he will, but the threat is there. He has very much said that he wants the 1031 tax deferred exchange to go away. And then you've got all of these other attacks that California is doing. So,
so Jason, just when you were saying that about California and what's happening there, and I was just thinking back to that Charging Bull artist, and this may be a stretch, but one of the things that artist, as you pointed out, was from Italy. And he created this beautiful charging bull that captured the American spirit. You think back the Statue of Liberty, that was made in France.
Right.
Maybe we need outsiders in some ways to remind us of who we are, because we're losing touch with that. We're losing touch with that spirit. Think of all the fear around COVID and this kind of just, not that we shouldn't take things seriously. Of course we should. And I'm a big fan of taking things seriously, but we sometimes get so enamored in fear, and we need some artists from outside. We need people to remind us of who we are. And that's part of what made that bull so powerful. That spirit.
That's a great point. Yes, we do. We do a lot of times need outsiders, non-Americans. And what's a great example of that is the immigrants that come here and do really well for themselves, or at least they used to, right? It's not the same world anymore as it was 50, 70 years ago. But these amazing stories you heard of Japanese people who during World War II, Sakioka comes to mind in Southern California, this penniless immigrant who became this huge landowner right near where I used to live, an office in Southern California, in Orange County, California, and owned the land that one of the most famous malls in the country is sitting on, South Coast Plaza. So amazing stories like that, and it really kind of can be a grounding thing and keep us in touch with the incredible value that others place on the American dream that we have to be reminded of, right? Because you tend to take it for granted if it's handed to you, right?
That's right.
Good stuff. Evan, it's your turn. Take over and tell us about some of the stuff you put together here. It's on the screen.
Well, it was all, there was an article I read it was Bloomberg, and it was by a really top-notch economist at George Mason University. And he was comparing the returns of the stock market to real estate. And this was a guy who's, probably as standard an economist as you could find, not somebody that's associated with left or right. And he said over 120 years, real estate has outperformed the stock market, and with less risk, because there's all kinds of measurements for the risk of a portfolio with less risk. And the most amazing thing, he wasn't even taking into account leverage. He was assuming that I think the data went back to 1880. And the data going back to 1880 is not perfect, okay? Especially the stock market data. Real estate prices are probably even better.
And guess what, though? It's not perfect today either.
No.
Because it's so highly manipulated. So that's what we're here for, is to help you see through that manipulation and interpret it accurately. But go ahead, yeah.
But if you bought a house in 1980 or 1880, and you bought a stock or the S&P 500 in 1880, I think the overall returns were 6.2% for the stock market and 6.7% for the house. And that's assuming you paid cash for the house. And so imagine if you put down 20% for the house, the returns would be times 5, right?
Right.
20 times 5 is 100%. So it would be
because
times 5.
leverage magnifies that return dramatically.
That's right. And so, and I was just blown away by that. Not that I needed any convincing, but it was really good data and really good history. And so I was asking myself, and we've talked about this, I was asking myself, why? Why is this? Because, when you work with one of our investment counselors, we don't just try to sell you. I mean, that's part of it, but we're educators. Jason is an educator. I always say Jason is extraordinary teacher. And it's like you get a high level class just by listening to the podcast, probably much more useful than you'd learn in college. And so you should understand why real estate works so well, because that's important, because then you understand what to look for in investment, how to compare, income property with other investments. One of the things that you often say, Jason, is sometimes you don't actually see the performance, but you do see it at tax time. And I say yay for that, because I was just working on my taxes and I see the cash flow from real estate and I see how depreciation and expenses knock it down. But anyways, so there are at least 7 reasons why real estate will always beat stocks. Always.
Yeah, good stuff. Okay, so we're going to get to those 7 reasons here. But tell us a little bit about this chart, for example.
Oh, well, this chart's great because it shows you how much risk there is in the stock market. I mean, look at these swings. Look at this, 86% in the Great Depression. The stock that's the from peak to trough.
So from peak to trough, you've got an 86% swing, because this is September 3rd of 1929 through July 8th, 1932. That's a 34-month duration. Now, Evan, we just got to put this in perspective, of course, because we're talking about the Great Depression, right? That was, most people would consider the worst time in U.S. economic history. And if you had mentioned the Great Depression, say before the year 2000, 21 years ago, people would have thought, dismiss that. He's out of his mind. Like, what's he talking about? Who cares? But now that we saw the dot-com bubble, we saw the 2007, 2008, global financial crisis, or the great recession, not depression, recession. And now with COVID, we know that we are on the verge of something, right? They have papered over it quite literally by running the printing press, and it has buoyed so much of the market, but it has created this massive Cantillon effect, because all of the people who already own assets have become so enriched. They've been able to refi their houses. They've been able to refi their apartment complexes. They've been able to refi their rental properties. They've been able to refi their commercial buildings and lower those mortgage rates. I mean, you know what I was thinking about today?
Jason, you're saying they. You should be saying you, because if people had listened to what you were saying, I was just a quick aside. If you listen to the Flashback Friday episodes, which I do, there was a recent episode which was from 2012, and I was listening to it, and I was thinking to myself, and I was swimming at the time, so I was like nodding my head in the water as I'm swimming. I'm like,
Evan has waterproof earbuds.
If someone had followed what you had said in that podcast in 2012, they'd be in Hawaii right now, sitting on the beach. Because they wouldn't have to work anymore. They wouldn't. I mean, it was like, buy some houses, take out loans if you can. And you were talking about Indianapolis, where you could get 2% or 2% RV ratios. I mean, if someone had listened and done exactly that back then, my goodness, it's amazing. You would have been following this strategy all along.
One of our clients today was talking about how, she listened to an old podcast, and I don't think it's the same one you're talking about, but where I was talking about properties in Charlotte, North Carolina, and in Indianapolis, where both two markets we're still recommending, for $45 a square foot, basically like 1 and 2 year old homes. They weren't brand new, but they were 1 and 2 years old, right? So you can't even come close to that today, right?
No.
But here's the thing. And then she was saying to me, well, everything seems so expensive right now. And I will tell you exactly what I said because it's here on my phone. Let me find it. I think this was a text message, actually. I reiterated. I said, it always feels that way. Then people look in the rearview mirror after some time has passed and everything looks cheap.
Yeah.
And that's just always the way it is with income property. It's the reluctant investor's lament, that great poem that I've shared often. So that's so true.
But yeah, and the other thing is,
but wait, hang on one second. I just want to say on this comparison to the Great Depression, right? Because that's where the chart starts. People would have said, "You're crazy. Let's not even talk about that. It's ridiculous." But now we've seen that the economy is very delicate, right? And if they had not pumped that money into the market, the question is, what would, in all fairness, real estate be doing right now? Not as well as it is, okay, for sure. The stock market definitely would have collapsed. There's no question about that because it did collapse. And then, Jerome Powell, or Rich Uncle Powell, just papered over it, right? And the Fed became the biggest asset buyer in the world. Go ahead, Evan.
Well, yeah, I mean, to go back to what you were saying about the reluctant investors lament, we shouldn't lament either. I like to tell these stories just to prove that what you're saying is so good. Yes, it would have been wonderful to buy in 2012, but it's still wonderful to buy now. Like I was thinking, my best performing stock, because I invest in the stock market too, much more in real estate, but I do some just to diversify. And I bought some Apple stock about 6 years ago. And I was thinking, man, I'm late. It's already gone up so much. Well, it's done really well over the last 6 years. So, you don't have to get in at the absolute bottom. These are durable assets. But one thing that was noting about this, since World War II, the two worst recessions have both been since the year 2000. We are in a much more volatile market in the stock market today. It's much more, computers can trade. Look, 59% 2007, 2009, 49% 2000 to 2002. We are in a time when markets can go up and down real quickly. And what is that old saying in the stock market? They take the escalator up and the window down.
In other words, they jump out the window going down, yep. Right? Yeah.
So that's why, one of the things we're going to talk about later is one of the advantages of real estate is its relative illiquidity. It's not totally illiquid. You can sell, but it takes a while to sell, and it's a long process to sell. So that is actually an advantage. The fact that it moves slowly is an advantage because you don't have those huge price swings, especially in the markets we invest in.
Yeah. Now let me get my screen back here, Evan. Sorry about that. Don't you love it when this stuff just kind of freaks out on you?
Well, it gives me a chance to look at the comments. Now, someone in the comments was saying, Jason, your houses have hardly 4% return. I don't know a polite way of saying this, but that's totally wrong.
That is totally wrong.
You need to look at houses have overall plus returns.
You need to look at the overall return on investment. And Evan alluded to that earlier. And by the way, I'm multitasking here, folks, so I apologize.
And the same comment,
it's like an iceberg. That's how you need to look at it, like an iceberg. Okay, and that iceberg is most of it is under the water. Of course, we all know the iceberg metaphor, and since most of it is under the water, that's how the returns are on your income properties. Evan said, you don't see all that return until tax time, but you also don't see it until you sell it, et cetera, et cetera. It's a multi-dimensional asset class. And there are many ways in which we earn our return on investment. It's
so you should only sell it after 27 and a half years, if you ever sell it.
Yeah, maybe, but the point is that it's not just about the cash on cash return or the cap, and it's definitely not about the cap rate. That's one of the worst metrics out there. I know it is commonly used in commercial real estate because their financing isn't very good. and their income doesn't increase that quickly like it does with residential properties. So not as good an asset. Okay, I found it. Getting back here, folks. Okay, I'm going back to that same slide. Evan, any other questions or thoughts?
No, but that illiquidity, that illiquidity premium is a good one. You know, the stocks move very quickly. Real estate moves relatively slowly. However, one of the good things about real estate is actually it is becoming more liquid as technology develops. And you know, that actually is good. It will actually, I mean, it may not be good in the long term, but it's good for people who own property right now because it gives you more ways to exit a property.
The market is definitely maturing, and there are a lot more things out there that are available to liquidate assets and so forth. But in fairness, the more liquid a market is, the more volatile it becomes. Okay, and that's one of the reasons that real estate is less volatile, because it's less liquid. Okay, you know, people sell slowly, the market moves much more slowly. You know, stocks very liquid, so very volatile. Okay. Okay, you want to look at any other comments or questions?
Well, no, I think this is a good chart to remember how volatile the stock market can be, and how, you know, with income property, you get both higher returns in the long run and you get less volatility. So it makes it an even better asset. Okay,
so let's go to this one.
Oh, well, this is the reason I pulled out this chart is this was from an article where the author, who was a professor, not Robert Shiller, but someone who I think teaches with Shiller, and he was saying, is the real estate market overvalued right now? And he was actually going back to say, was it overvalued in 2008? And he actually made the argument that it might have been temporarily, for a brief period of time, overvalued in 2008. But he essentially is saying this time it's different, which I guess is a dangerous thing to hear. Yeah. But he said that real estate prices are going to be higher for the future for a few reasons. First, because of lower interest rates. He basically says we're in a time where interest rates are going to stay low for a long time. And he also said, essentially, while the United States has plenty of land still to develop, a lot of the really good land, good locations have been developed. And so there are less, you know, you mentioned the Japanese immigrant who bought all the land, and, you know, a lot of that is in prime real estate that you really can't recreate land like that anymore. You can't build another Las Vegas. A lot of that is sort of already priced in. So he essentially is saying, you know, we over the last 20 years, we've sort of been in a repriced era of real estate that is just more valuable. And so we're really not in a bubble at all, which you have argued before for slightly different reasons than this author argues. But what you've essentially have said is, no, the value drivers are there.
Yeah, no, I am, you know, here's another one I got for you. I got to tell you. So I saw a comment today on one of my feeds that, you know, someone liked my stuff. They liked my education, all this kind of stuff. But they said I was talking my book, right? Because I'm bullish. I'm bullish on real estate prices. And I said, basically, my answer was, you are totally misinformed. Right. We have buyers coming out of our ears right now. Buyers are a dime a dozen. Everybody wants to buy. Okay. If I wanted to talk my book, if I was doing that, okay, I would be saying, I would be lying. I mean, I don't believe this, but this is what I'd be saying if I was talking my book. I would say, sell, sell, sell. Properties are going to decline. And the reason you should sell, and I'd make up all these reasons.
And then we'd buy them all.
And then, not that I'd buy them all. Sure, I'd buy some of them, right? But we'd have more inventory.
Yeah.
We don't have any inventory, folks. There's like so little inventory. And look at one of our comments from Rated here. I'll put it on the screen, okay? Austin, Texas, got 2 duplexes last year, 2 months apart, looking to buy another, and it's damn near impossible right now. There's nothing, he says in capital letters. I did not buy in Austin. I did not buy in Austin, elsewhere in Texas. So, there's no secret that inventory is incredibly scarce. If I was talking my book, I would be trying to talk people into selling, not buying.
Yeah.
I don't have to talk anybody into buying.
And let me just, obviously working for you, I'm not unbiased, but I would say you are extremely honest. And if you were in it just to make money, you'd create a syndication and people would sign up for it, and you could make a lot more money doing that.
I'd make way more money doing that.
Yeah, but you don't believe in that. You believe in this because of the fundamentals. It has nothing to do with how much money. I would be suspicious if someone wasn't talking their book. I want people to believe in what they're doing because, if someone isn't invested in what they're trying to sell, that makes me more suspicious than someone who's really passionate about what they sell.
Yeah, of course. And when you say doing this, basically we help people directly invest. Right. We believe in direct investment. My commandment number 3 is thou shalt maintain control, meaning that you are a direct investor. You pick the property, you buy the property, you own the property. It's your property. You can decide what to do with it, how much to rent it for, when to refinance it, how to finance it in the first place, when to sell it, when to improve it or not, whatever, right? It's you are a direct investor. And that's the way people get really, really rich. The way others get rich is off other people as they start a fund and then they collect money like Kathy Wood. Okay.
Yeah.
Go ahead.
And somebody wrote, in this overvalued market, I don't think hoping prices to increase is wise. I don't think it's an overvalued market at all. I think in some ways, I think it's an undervalued market. And I think
it's not overvalued yet. It will be at some point, but
of course it always, that's capitalism. It always overshoots.
I'm looking for that comment. I want to put it on the screen. Oh, here it is. It's the last comment. Okay. This overvalued market, I don't think hoping prices increase is wise. It's just, I don't know why people think it's overvalued. Right. Housing is, from a mortgage payment perspective, your mortgage payment today, I don't want to say today,
because something
at least as of 4 months ago, your mortgage payment 4 months ago, and it's about the same today, it's not that much different, is cheaper than it was 14 years ago. Okay? When you look at it from a mortgage payment perspective, which is how everybody buys a house, nobody buys it on the cash price. They buy it on a mortgage payment perspective. Houses are cheaper, adjusted for interest rates, inflation, and current prices. Okay?
I think people think
it's overvalued.
I think, Jason, I think people think because real estate prices have risen so much this past year that they're overvalued.
Just because they're only looking at the price. They're not looking at the monthly payment. Right. They're not adjusting for inflation.
Right. And COVID. That has been good. It's been good in some ways because people realize the value of a home. I'm sitting in my new home office here. Yeah. But the other thing is, imagine how many people didn't want to put their home on the market because they were afraid of people coming into their house with COVID and masks and everything. Yeah. And that once the economy returns to normal, there's going to be even more price increases and more demand.
Right. Okay. A follow-up here. This is a good question. A. Ramis. Okay. So you are correct. Yes. Property taxes are higher because those are indexed to the price of the house. Other expenses, I don't know. Insurance, maybe a little bit higher, but it's not hugely significant. But those things also have to be indexed to inflation. Remember, we must deal in a world of real dollars, not nominal dollars. Okay, let me show you something. Evan, I don't know if I've shown you these before, and I'm going to show them to everybody. One of my podcast listeners, a longtime listener to the Creating Wealth Show, many years ago sent me a gift, and I just found them again. I was looking for them. And here's what he sent me. He sent me these beautiful Zimbabwe dollars. Okay.
Yeah, you showed that to me once.
You saw these? Okay. Yeah. So these, you'll look at these. These are Zimbabwe dollars. Here is a $50 trillion bill. Okay. That's 50 trillion Zimbabwe dollars. And here, Evan, If you need to buy a coffee, I'll give you a $20 trillion bill. That'll get you a latte, okay? And here is a $100 trillion bill, okay? 100 trillion Zimbabwe dollars. And look at the Zimbabwe dollar used to be worth something before they debased the currency, before they inflated away the value of it. All right. So we have to adjust everything for inflation. So we're talking about real dollars, not nominal dollars. So what do I mean by that? Nominal. The definition of the word nominal means, I mean, look it up. It means in name only. That's nominal. If this were a $100 bill and I asked you, what is it? You'd say it's a $100 bill, right? If just assume it was a US dollar, right? It's same thing with Zimbabwe dollars, doesn't matter, right? And if I asked you that's the name of it today, and guess what the name of it was 50 years ago? It was still called a $100 bill, but the value of it is lower today. So you have to adjust the monthly mortgage payment for interest rates, current prices, which are higher. Current prices are higher, okay? But then you have to index the prices to inflation, and they're not as high as you think they are, okay? And then you have to index the property taxes, the insurance, everything has to be, so you're considering it in real dollars. And guess what else has gone up? The rent has gone up in both nominal and real dollars. No so we got to think in real dollars, not nominal dollars, okay? Okay, Evan, thoughts?
No, 100% agree, and that's the beautiful thing. And one thing that you've always taught is rents don't move as fast as prices, but they eventually catch up.
Right.
And so I've started to see that, in Memphis, which is one of our great markets, and I wish we had more inventory there right now. But prices have been going up in Memphis the last 3 years. Really, it's a nice appreciation. And I own some properties there, and I have
been going up pretty much everywhere. But yeah.
Without question. So yeah, we have a great student here, Anthony. He's answering the questions before we can.
Thank you, Anthony. Thanks for your answer. That's a good answer.
Yeah. That's where it's.
Oh, hey, wait. Anthony made another comment here. And besides, appreciation is simply icing on the cake. I never count on appreciation to make my properties pencil out. I invest in cash flow and sometimes value add. Anthony, yeah, absolutely. Here, let's give Anthony a hand. Okay, there you go. Good stuff. Okay. All right, let's move on, Evan. So anything else you want to say on this chart?
No, it's a good chart.
Okay.
A good chart.
Okay, so here you go.
Yeah. This is what I was talking about earlier. This is that study I was talking. Equities averaged, I was wrong. I said 6.2 and 6.7. It was 6.7. Equities, this is since 1880. Equities average a 6.7% return per annum and housing 6.9%. For the US alone, equities return 8.5%, housing 6.1%, the latter figure being lower, but still quite respectable. The standard deviation of housing returns, one measure of risks, is less than half of that for equities, whether for cross-country data for the US alone. So it's less risky. And the 6.1 and 8.5%, remember, that's not including leverage. That's assuming you pay all cash.
Yes, thank you. Yeah. Absolutely. So, here, wait. That's assuming no leverage. It's all cash. For the equities, you're not leveraging them. For the real estate, hopefully you are. Yes, absolutely. That was actually the wrong sound effect. Okay. Here's the one I wanted to do.
Just, yeah. So for the very basic, for those of you, imagine you have $100,000 house, and let's say it goes up 6.1%. So you have 106,100. But if you took out an 80% loan, you only paid $20,000. So you got a $6,100 return on $20,000, not on $100,000. Yep. That's why it's so much better.
Absolutely. The leverage makes it phenomenal.
Debt is your favorite 4-letter word.
Debt is my favorite 4-letter word. Exactly. And but good debt, mortgage debt, good quality, long-term fixed rate mortgage debt that is paid by somebody else. See, people, remember this phrase, write it down. When we use debt on income property. It is self-liquidating debt. Self-liquidating debt. Okay. The debt liquidates itself. It pays itself. The tenants, we outsource the repayment obligation to the tenants. We don't pay our own debts. I don't like debts when I have to repay them myself, but I like it when someone else pays them. You can delegate, you can outsource the debt obligation to the tenant. So,
and not only are the returns better with real estate, and we're numbers people, we love returns, but there is also just a general comfort level. I mean, especially now when you see the stock market and you see how something that is at 10 can go up into the 300s and then back down to 40. It's almost like you can get crazy watching the stock market. I'd rather, as you said, a slow, steady ship, good income property in good cash flowing markets, giving me a check every month that I can rely on. I don't even have to think much about it. I can turn off the TV, turn off the noise, and just enjoy my good returns. That's, especially as you get older, that just becomes even more valuable, that peace of mind.
It's a lot easier. It definitely is. So Anthony says, tell him about inflation-induced debt destruction. Thank you for the reminder. So I like this big phrase so much, I trademarked it years ago. And so inflation-induced debt destruction, inflation pays our debts back for us too. Okay. And Anthony, thank you for the reminder on that. We don't have time to go into that today because it's a whole topic for like a whole show. But of course it's on the podcast. It's on the YouTube channel. And you can learn
Didn't
about
you
it.
trademark that term?
I did. Yeah.
Yeah.
Yep. It's a registered trademark. So, but that will not stop sleazy operators from stealing my ideas.
We know that.
They're out there, and he knows who he is. He might be listening. He's a thief. I have a thief, at least one out there.
At least one.
Well, actually, no, I know I got another one. I was listening to this woman the other day, and I was thinking, you sound just like me. You're saying everything I say. The home is the center of the universe. That. Like I was like,
I'll never forget when that person copied. I'll never forget when that person copied the whole Sofa Summit idea, because I remember you saying that term and said Sofa Summit. I said that is really brilliant. Yeah. And then literally 3 weeks later, I got an email from.
Well, ideas float around. There's no question about that. I mean, look, I learned from someone else back in the 80s, okay, a long time ago, right? So we all learn from other people, okay? But when you just don't have any original ideas and you're just like copying people ad nauseum, it's just pathetic. Yeah. Okay, so you talked about leverage. Anything else on leverage?
Yeah. Well, I mean, it's the greatest thing. I mean, it just allows you to do so much more. And, leverage can be dangerous too, of course, in the short term. But one of the things that I think is there are certain underlying assumptions for our investment and in fact, for any investment. And one of the big underlying assumptions is over time, prices will rise. What is that? The Phillips curve. And, the fact that there's an increase in population, like there are certain base assumptions that in the aggregate long term, now it hasn't been true in Japan for the last 30 years, but in the long term, prices will rise. And so when you use prudent leverage over 30 years, you're going to do well. And I remember reading that really over every 10-year period, real estate has risen in price. So, leverage just gives you, it magnifies those returns. But as you always say, Jason, you have to be able to get through the difficult times. There may be a 2-year, 3-year period where prices go down. And if you're over levered and you have no reserves, you're going to be in trouble. That's why we teach our investors to have reserves.
Right.
But in the big picture, leverage is magic.
Got it. So we teach them to have reserves, yes, but not just that. You buy properties that make sense from day one. Commandment number 5 is thou shalt not gamble. The property must make sense from day one or you don't buy it. The reason people get into trouble with leverage is because they buy a property that just never made sense. They were speculating on appreciation. It's like buying Bitcoin with your credit card. That is a death sentence. And it wiped out a whole bunch of people last time around, right? And there'll be pullbacks. These cryptocurrencies are insanely volatile. These are very speculative assets. Okay. And listen, I own a little bit, I'm going to play with a little small amount of money. Okay. But you don't make that your main money. It's only what you can afford to lose.
Right.
And when it's a volatile asset that is not self-sustaining, meaning it doesn't produce income, someone else doesn't pay the debt for you, then you do not use leverage. Okay. Leverage is only used when someone else pays the debt. And ideally you have some positive cash flow beyond the amount of leverage you're using.
That's right.
Okay. And it's a really conservative asset class like income property.
Well, you always say the best insurance is a big loan balance. I mean,
right. Yes. And that's more in the natural disaster and economic peril kind of way.
And if you really want to understand that idea, you're going to have to read our book.
Yeah.
I'm just teasing that.
We should have talked about that. Gosh,
we got to do another live stream.
I should have put the book cover on here.
Yeah.
Well, I didn't. Well, Evan and I have a book coming out, and guess what it's called? Here, I'll show you. It is called. There.
Empowered Investor.
Empowered Investor. Yes.
That's you. Those are our clients. You're empowered. We're just your guides. This is the hero of the book. Every book has a hero.
Is the investor. Yeah.
It's not Jason. It's not me. It's you. It's the people who get up and invest. We're just your guides. We help you along the way, but it's you who make money. It's you who take action and really take advantage of this asset class, because we're just there to show you the way, but you take action with what you learn in this book. It's off to the races.
Right. And on the podcast and the YouTube channel and that kind of stuff. So the book isn't out yet, folks. So stay tuned for that. But I love the book cover. I think it looks really good. And okay. So refi till you die. What do you want to say here?
Well, I mean, that is another advantage of real estate over stocks. Now, if you want to get your money from stocks, you have to sell. Now, you could take out a loan against it, a margin loan. I don't advise it. It's riskier. So essentially, if you want the cash from stock appreciation, you have to sell. If you want to pull out, and then you pay taxes on what you sell.
Right.
If you want to get your money out of real estate, just refinance it. Yeah. And that's, so let's say, what Jason teaches is it's like every 12 years, but it could be it depends on the time period. So if you have a property that has doubled in price, you can pull out all of the cash you put into it, plus some bonuses, get another loan against it, and you have this big chunk of money. And not only do you have that chunk of money, you don't have to pay taxes on it, because technically it's a loan, but it's a loan against yourself. So it's a beautiful strategy, and we can't explain all of it now.
It's a beautiful asset class, because it's one of the few asset classes where you can buy it, you can get all your money back and still own the asset. And you get all that money out of it tax-free, because there's no tax on borrowed money. And when you lever it again through that refi, you add more leverage to it. You're adding leverage that is paid for by the tenant, not you. That's why income property is the most historical.
I heard someone say something that I just thought was clever. He said, "Why earn money when you can borrow it?" Now, that's taking it to an extreme, but
that's what the government believes too.
It's borrowed money's the best money. You don't have to pay tax on it, especially if you're borrowing to buy an asset.
Okay, scarcity.
Yeah. Well, what is the Will Rogers are saying? Buy land. They're not building any more of it. Now, the truth is, if you go on any flight in America, you see vast stretches of land. So there is a lot of land to develop, but it is limited. And there especially land in good suburban areas near thriving cities, which is what we, cities like, Tampa.
Doesn't need to be near that thriving city anymore, though.
Well, no, I'm not talking about New York. I'm talking about real thriving cities like Jacksonville. And
Yeah.
I just read an article apropos. This is in the Wall Street Journal today. Basically said blue collar jobs are booming right now. Booming jobs, not in the hospitality industry, but in construction, in delivery for warehouse delivery. I mean, there is a huge increase in demand, and these are our renters. And so that is to be able to own properties in those areas. There's not that many areas like that, so it's scarce.
Yeah, yeah, no question about it. And the other thing that's scarce are the commodities that are the ingredients of that property.
Packaged
So
commodities.
the packaged commodities investing strategy that I've been teaching for 17 years now, the copper wire, the glass, the steel, the lumber, the petroleum products, the concrete, the et cetera, all of these building materials are incredibly short supply. We have other videos on that on the YouTube channel and podcast about that topic in depth. So be sure to check it out. In fact, you can go to jasonhartman.com and type in Hartman Risk Evaluator. That's the system I made up to virtually eliminate downside risk on a real estate investment. So check that out. Okay, so the illiquidity premium, and I love this, Evan. This is great.
Yeah, I love this terminology too, and this goes back to what we were saying about that real estate is less volatile and less liquid than stock market. I mean, the stock market, it takes 2 seconds, less than that, to make a trade, and you can go in and out, and you can get addicted to it, and you can pull the trigger too fast. You can be in a bad mood today, and you can see awful news on the stock market, and then your girlfriend broke up with you, and you're all down. You're like, the world's going to hell. I'm going to sell all my stocks, and you do, and you can do that easily. Yeah. You can't do that easily. So in some ways, the illiquidity acts as a check. It acts as a check against some of our human emotions. Yeah. And by the way, I first learned this term illiquidity premium, not in real estate, private equity. Mm-hmm. Private equity has an illiquidity premium. I mean, almost all the good private equity places say, you got to give us your money for at least 5 years, right, because we're thinking long-term. And I remember reading that illiquidity premium, they estimate adds 5 percentage points to the return. Mm-hmm. And I think it adds much more in real estate. So
yeah, and you know what's interesting about that? That was really good the way you put it, that it's a check on human emotions, right? So you don't let your own psychology get away with you as easily with the real estate because it's not very liquid. So you can't sell it in the wrong mood. But not only that, the whole market is bound by that too. So the market doesn't create a flash crash. There will never be a flash crash with real estate. There will definitely be flash crashes with stocks and cryptocurrencies. Absolutely.
Right. When it comes to the emotion, I just want to say one more thing. And I have just noticed this about myself. When buying stocks, the emotion is it's hard to sell sometimes when you should sell. It's easy to buy. I often find that when I'm buying a property, it's actually harder to buy. Like I can convince myself not to buy. And so the harder emotional hurdle is actually buying. And every time I have bought, I mean, really, I've been happy I've bought. Even the first property, usually the first property you buy is not the best returning one unless you buy with us. But, and even then, sometimes you just learn what kind of properties you like. But even the first house I ever bought, it's been excellent. I mean, as I learned more, the returns got better. But the only regrets I have are for things I haven't bought. So it's overcoming that emotional hurdle to buy. And then it's difficult to sell. It costs money to sell, which I think is good. So that's the hardest emotional part is really buying. And then once you can overcome that, you're in good shape.
Yeah. Yeah, good points, Evan. This is interesting from Austin Bates. What happens if the left continues eviction plans? Will they bans? Will they protect landlords? Well, the left isn't friendly to landlords or businesses, but I wouldn't let this stuff worry you that much. If you really get into a bind, you just go into a mortgage forbearance program and stop paying the mortgage. It's a game of hot potato. It all happened during the Great Recession. It happened in the 90s too, during a recession in the mid 90s. I was a real estate agent then in Irvine, California, and I saw lots of people sit in their houses or own rental properties and collect rent for a year without making a mortgage payment. So it can actually benefit you, believe it or not. I saw lots of people do it in 2007, 2008, 2009, 2010, where people were collecting rent payments. Sometimes they weren't the full payments, but they weren't making any mortgage payment. And the lender was paying the impounds on the property taxes and the insurance. So I'm not saying this is something you should do. I'm just saying it's a nuclear option. It's a worst case scenario option. So I wouldn't let that worry you too terribly much.
Agreed.
Okay? It's something to watch, but it just hasn't had any real impact so far.
And the truth is, the headlines are much worse than the reality.
Yeah.
The reality is, if someone wants to, if you need to evict somebody, and they're going to try to say you're not allowed to evict, they have to go through a huge process of proving that because of COVID that they cannot get a job. I mean, it's not just you can't do it. The onus is on the tenant to do all the forms to prove that they fit the criteria. And many states are still processing evictions. Not that you ever want to be. I mean, no one wants to evict somebody, but it's not as dire as the headlines lead you to believe.
Yeah, and it mostly applies to these institutional apartment complexes. In the single family homes, this is just a non-issue. I almost never hear of one of our thousands of clients having a problem with rent non-payment and that they can't evict. Or, I mean, we hear this stuff on the news, but in the single family rental market, it is just not that big an issue, at least not yet. It may become one, I don't know. But so far, knock on wood, it hasn't been. Okay, I want to address this issue A. Ramus is bringing up, because this is a good issue. Okay, so asset doesn't have to produce income, you're saying. Okay, so I would argue that you're right. An asset, you can have an asset that doesn't produce income, like precious metals, non-dividend paying stocks, cryptocurrencies, or properties that don't produce income. Okay, but those, you might call them an asset, but you can't call them an investment, because my definition of an investment is that it must produce income. So in my world, vacant land is not an investment because it doesn't produce income. Precious metals, not an investment. Cryptocurrencies, not an investment. They are assets, you're right. And they are speculations, and they are gambles. Okay, now they might be educated speculations, educated gambles. Sure, great. And you can make money on them sometime. But for my definition, if you want to be called an investment, you must produce income. Okay, or it, I should say, not you, obviously, but it must produce income if it's to be called an investment. Okay, so that's an investment.
I think I tell that story, or we tell that story in the book about when you were in Orange County and some guy called up and was trying to sell you gold.
The gold dealer, yeah, with Monex.
Yeah. And you're like, I'm going to buy some, okay? But let me just ask you, can I give you 20% of the price? And also, will you pay me rent?
20% down.
Yeah.
Yeah. And will you pay me income? Can I rent my gold out? No, you can't do any of that stuff. So that's why income property is so much better, because it's multidimensional. Okay. So Stay Curious says, yeah, I would not buy Bitcoin now. I would wait until later and then buy Ethereum. Yeah. All just highly speculative. People have made money, obviously, but it's a speculation. A friend of mine just bought a home in Florida, and I think this is one of the best places to buy a home right now. I agree. I live in Florida. Florida is booming. It's open for business. We've got an awesome governor. Just because, well, see, that's where I disagree with you. If it doesn't produce income, I think it is a speculation or a gamble. Now, like I said, though, it can be an educated gamble. It can be an educated speculation. It doesn't mean you're going in blind. It just means that it is speculative. Okay. Okay. So here's a big one. Okay. My company's stock, EXP. Yeah, if you've made a lot of money in that stock, Brent, then I would, take a little bit of those chips off the table. I mean, in financial planning, there's a concept of dollar cost averaging in, right? But you also dollar cost average out, okay, just to protect yourself. The late now Kenny Rogers had that wonderful song. You probably all know what I'm going to say. You got to know when to hold them, and you got to know when to fold them. You got to know when to walk away, and you got to know when to run. You never count your money when you're sitting at the table. There will be time enough for counting when the dealing's done. That song is brilliant. Okay. So take some of those chips off the table. Maybe you keep some in, but you don't have it all in, right? So, okay. Inflation. I think they get the point of inflation. Okay. So, universal demand, Evan.
I mean, that's just, people always need a place to live. You need shelter, and especially single family homes. I mean, where did people flock to during COVID? And still, they flock to single family homes and not apartment complexes. Single family homes don't have elevators. Single family homes don't have thin walls, don't have common areas where people gather.
And they're not usually in areas where you're required to take mass transit either.
Right. That's your 22nd commandment. Thou shalt invest in low density areas. And that's where single family homes are. And universal demand. I mean, who wouldn't? I mean, I guess if you can have a big, beautiful penthouse apartment, with a great view, okay, that's special. But in general, most people would rather a nice single family home than an apartment. It's part of the American dream. And so there's not always universal demand for stocks. Stocks are paper assets, and stocks have only been around for a few hundred years,
and they can be created indefinitely. There's no limited supply to stocks because you can just create another stock easily, right? Right. Okay, so this is a good question from CV. Jason, I'm looking to purchase a rental property through your website, and I noticed that inventory is a bit low. Well, that's an understatement. Okay, inventory is extremely low. Do you have any new inventory coming up? Thank you for asking that question. That's a great question. So let's address it. Yes, we always have new inventory coming up. Virtually every day we're getting new inventory. However, you must be working with an investment counselor. And Evan will tell you this because he's an investment counselor, okay? There used to be a time, several years ago where there was enough inventory where you could just go to jasonhartman.com and you could find properties right there. Now they come and go so quickly that you've got to be working with an investment counselor. You got to be talking with someone on our team. It's a little bit more of a manual process now than just go on the website, pick a property and buy it, because the properties just go so quickly. Sometimes they don't even make it to the website. So it's really important that you are engaged and working with one of our team members. Evan, you got to comment on that because you do this every day.
It is absolutely essential. It's absolutely essential. And if your investment counselor calls you, talk to them if you're interested, because I tell you, when I talk to a client and I get a sense, okay, they want a property that, cash flows around this, they're more comfortable in this kind of hybrid market versus linear market. I know. And then I look for that property. And yes, as Jason said, sometimes they don't even get up on the website, because we are talking every day with our local market specialists. So we know what they have coming, and we know which investors, which of our clients are looking for something. And so you definitely need to be working with an investment counselor. Really, that's part of the beauty, is that it doesn't work like a stock where you just get a list and you just click, I want 100 shares of this. It's much more of a process where you really could use some good advice. And that's what we do. I mean, yes, we want you to buy property and we're your guides and your coaches, but we also want you to buy the right property. I mean, almost none of our clients just buy one. So they buy multiple. So we want you to be extremely happy with what you buy, and we help you get there. And that's one of the beautiful things about Jason is he wants to find investment counselors who are also clients and who also own income property. I own tons of it. all of stuff that is exactly from the network and exactly fits what the kind of properties that we sell.
And you were a client before you worked for us.
Yes,
yeah,
of course.
Yeah.
I would ask whenever I buy a service. I bought some insurance recently. I want to know you have this type of insurance too, right? I want something where the person helping me is invested in it. I want there to be a conflict of interest. That's such a bad, which is not really a conflict of interest.
It's not a conflict of interest. I mean, what do you mean by that?
I don't, not a conflict of interest in the sense that I know that they're invested in the product as I am. They're invested in the idea as I am.
I think that's an alignment of interest, not a conflict.
What's that?
That's not a conflict.
No, I'm saying it in a facetious way.
Yeah.
Like technically it is it's not really a conflict, but if you're watching CNBC, which you shouldn't watch, but if you do, and somebody recommends a stock, you have to show, does he own that stock? And if it's yes, you're like, is he recommending it just because he owns it? I say to myself, that's good if he owns it. I want that. So it's not a conflict of interest. It's an alignment of interests.
Yeah. Okay. Good stuff. Adjust for risk. And I see that Sarah's on here. Hi, Sarah. Go ahead. Adjust for risk, Evan.
What I mean by that is, I should have said adjusted for risk, was kind of what I was saying earlier with that study I was citing. It has one standard deviation less, and standard deviation is the way that statisticians originally started at the University of Chicago, and I'm in Chicago. They evaluated a stock investment portfolio by the standard deviation, which means how much does it stray from the typical, the average performance, and the larger the standard deviation, the more risky an investment is. And real estate has a much lower standard deviation, almost half of the standard deviation of the stock market. So it's just less, it has less big swings. I mean, the Great Recession was an abnormal event. Probably something like that. The Great Recession in housing, probably something like that won't happen again for a long time. Whereas bear markets will happen. They must happen. So
and remember something else, a lot of the world has a lot of the stock world has become just index fund investing. Okay. Which I think was the smarter way to go. I'm not sure that's still true, because the indexes kind of sort of pollute the market with lack of analysis. And what I mean by that is, people are just becoming lazy stock investors now, where they're not really, and I'm saying this is like the whole market, the whole industry. It's a giant industry, obviously, right? Where they're not really analyzing these companies anymore. It's real lazy. They just put it in the S&P fund, put it in the Wilshire, whatever it is, right? And that means that you're not getting any sorting. It's like stock socialism. It's really could mean something very dangerous. But where I'm leaping off on what you just said, Evan, is that, remember, now we haven't had this in a while, but bear markets can last a couple of decades. Okay. It's happened before, folks. So, it's not always that, we're going to have a bear market for a couple of years and then it's going to turn around. That doesn't always work that way. You could have a 20-year bear market. Okay.
Right.
I mean, just go back and look at the history. There have been very, very long bear markets. And if your retirement is depending on those stocks, be careful.
Right. And we can have a bear market in stocks and you're still in real estate, and you're still collecting rent. But I want to get to a comment from one of our clients. I think he's Sarah's client, Damon Santa Maria, who's been on the show before. Yeah. And he said something.
And I wrote the forward to his book.
So he's pointing out that the returns right now that we see on the website are lower than they were 2 years ago. And I was talking to a client on Friday who bought a property with me 3 months ago, and he's doing great and he wants to buy more. And I'm so happy. And he's saying, and we went through the numbers on his upcoming purchase, and he's like, but I'm not making as much cash flow as I did. And I said, yes, you're right. And I can't sugarcoat it. Interest rates have gone up from where they were 3 months ago. They just have, and there's nothing I can do about that. And yes, prices have gone up. It is true that we cannot get the deals we got 6 months ago, 3 months ago even. But here's the thing. With the properties that we have right now, especially the new construction, you've got to remember that the maintenance costs are going to be much lower, and interest rates are still relatively low.
And those properties appreciate better too.
Yes. And interest rates, I was reading another article about this. Interest rates were abnormally low starting from about August to January. And this article was on Mortgage News Daily. And it was like Matthew Graham, who's like the mortgage expert of the world here. And he was essentially saying there are always small periods of abnormality where mortgage rates get really below the 10-year bond level. And he said, but this was a misprice for the longest period he's ever seen it. He said now mortgage rates are getting back to where they should be, which are still pretty low.
Oh, they're still artificially low. Come on, these rates are ridiculous.
Artificially low.
They're dysfunctionally low.
Yeah. I mean, but they were out of sync with the 10-year even.
Right.
And now they're much more in sync with it. But
right. Fair enough. That's a good way to look at it. Yeah. Good stuff. Hi, Damon. Yeah. Thanks for the comment. Okay. So tax incentives, Evan.
Oh, well, as I was saying earlier, I was just preparing my taxes, and my taxes are great, are really nice this year, partly because, I'm making more money from real estate and income properties, because there are so many tax incentives. The federal government wants us to buy real estate because it provides housing for people. And if we're not providing housing for people, somebody's got to provide housing for people, and so there are so many incentives, the golden one being the Fannie Mae and Freddie Mac, which I know, Jason, you have talked about how you're philosophically against it, but pragmatically, it's phenomenal for real estate.
Well, that's not a tax incentive. That's just what you're meaning there, although is incredible. That's that income property, if you get a Fannie Mae or Freddie Mac loan, is essentially subsidized by the government.
Right.
So if you want your welfare, this is welfare for the middle and upper middle class. That's what it is, right? Okay. So if you want your welfare check because you feel like you pay taxes and you never get anything back, go get a Fannie Mae loan. Okay. The property is basically subsidized by the government. And so take advantage of that. The artificially low interest rates are basically subsidized by the government too. But then you get tax advantages. You get the 1031 exchange. You get the depreciation. You get the interest write-off, the expense write-offs. It's the most tax-favored asset class in America.
Right. Yeah. And the other principle here, this I think is one of your greatest insights. Not that all the insights are great, but the most powerful forces in the world are central banks and central governments. Yeah. Now, you've interviewed, who's that guy who wrote The Creature from Jekyll Island? G. Edward Griffin.
G. Edward Griffin, yeah.
You've interviewed him on the show a couple times, and those are some great interviews. And he is, essentially sees the Federal Reserve as a great conspiracy. And there's a lot of, there are people who say the Federal Reserve is actually a very positive force, that Ben Bernanke. So, we can disagree. I'm probably closer to Griffin, but I see the reasoning for it. But in any case, it's there and it's extremely powerful. And would you rather align yourself with these powerful forces and figure out how to profit from it, or constantly go against it? Well, I don't know about you, but you've said, Jason, you're an opportunist. You're not an optimist. You're not a pessimist. You're an opportunist. Yeah. And so we should invest where the Federal Reserve is incentivizing us to invest, and they're incentivizing us to invest in real estate. Because if inflation goes up, hard assets like real estate go up too, and we benefit from inflation-induced debt destruction so much. So buying income property is a way of doing what all the big guys do, but doing it on a smaller scale and profiting from these institutions.
Absolutely. As I always say, align your interest with the two most powerful forces in the entire world, the two most powerful forces the human race has ever known: governments and central banks. And that's exactly what we teach.
Which are pretty much one and the same, even if not legally.
Yeah,
but
they're like this.
right.
They're like this,
Yeah.
fingers crossed, definitely. Yes, Dennis, free speech is definitely getting filtered. It's a scary time in the world. I'd say that's the world's biggest problem is free speech. The censorship that's going on with these big companies. Do the rules apply? Does anyone know if the same rules apply in Canada? No, they are different in Canada. The US has a very special, very unique mortgage market. We have a lot of Canadian clients who buy properties here in the US through our network. Again, they can't all take advantage of everything that we do. Okay. You can still take advantage of a lot of it. You just can't do quite everything the American citizens do. Okay, so here's one from Steakhouse. Jason, one concern I have, inflation does hit the U.S. hard, food, insurance, tax, water. Are you concerned? No, I'm not concerned about that, and I'll tell you why. I mean, it is a concern for the overall economy and for society. I'm definitely concerned in that way. But for our own portfolios, I'm not concerned, and here's why. If people can't afford your house, they will just have to move into a lesser house. We've already been seeing this. Look at it as like there's two ladders side by side. And the types of properties that we recommend that you can buy through our network, you will catch people moving up the socioeconomic ladder or moving down the socioeconomic ladder. So, if things get really bad, your tenants in the future, say 5 years from now, in a time of great crisis, possibly, you'll ask them, about their former life. Well, where did they move from? And they'll undoubtedly say, I moved from a bigger house in a nicer neighborhood in a better school district that had nicer finishes. And I owned it. And now I'm renting this cheaper house from you, right? And that's just the way it is. People have to, move to what they can afford. And that's the market always adjusts that way. It's nothing new there. So I'm not concerned about that. Okay. Can you do a 1031 exchange? Yes, you can do it anywhere in the United States. And I've done that many times, Dennis. So I seem to do about one 1031 exchange for my own portfolio every single year. We do many of them for clients. And I'm entering into another one now, kind of moving my portfolio around a little bit. And so you can, we commonly have people sell a property in a high priced market, California, New York, whatever. And then they'll buy a whole bunch of properties through our network on a 1031 tax deferred exchange. They defer the taxes. They don't pay any of that. And they increase their cash flow massively. Let me tell you about one client that Sarah and I helped years ago. They came to us. They had inherited a beach house. I believe it was in San Clemente, California. They sold it for, I think, like $2.7 million. They bought 39 rental properties through our network. We made that exchange happen for them. So they did not have any gain or any what's called boot. That's what they call it, that they had to pay tax on. We found them a whole bunch of properties and they made a ton of money on that. Their cash flow, I profiled the whole story on the podcast.
Yeah, it's a good podcast.
Yeah, I got to find that podcast because that's a really good story. We need to like earmark that podcast and send it out to people because
what didn't you do
amazing.
Didn't you did one podcast where you talked about I call it the twofer, where you sold a house in
I do the twofer like every year. I do a twofer myself.
A house in Austin, and you bought two in Memphis.
Yeah, that was Charlotte. That one was Charlotte.
Yeah, increase your cash flow by $600.
Yeah, I know. So you sell one, you get either two or three. I call it the twofer, like it's usually two houses you'll get. But if it's a big property, you can get a whole bunch of houses. My mom's doing this right now. She's selling two of her big California properties. Well, I mean, one of them's kind of really big, and another one is
finally convinced her.
Yes, she finally came around. Yeah, and she's buying in Florida, so she's doing all that stuff. So Wookie World asks, where am I buying properties? Well, I'm not sure yet because I'm in the selling mode now, and I got to identify my new ones within 45 days of the close. So I'm looking at several Florida markets. I'm looking at Charlotte, and I'm looking at several of the Alabama markets. Not sure what I'll do yet. I might have to break up these exchanges into multiple exchanges. So, listen to the podcast, The Creating Wealth Show, and I'll tell you more as we go. Okay. Any particular firm? Yes, we do have a 1031 exchange accommodator that we highly recommend. We've got a few of them, but we've got one we just love, one I've used many times, and our investment counselors can refer you to them. They do a great job. Yeah, they do a really great job. Okay.
I'm working on a 1031 with a client who is selling in San Diego and buying in Alabama. So it's terrific.
Yeah, that's a great scenario right there. Wise of her to sell the California house. A lot of people, yeah. Now, a lot of people are leaving all these. It's not just California. They're leaving New York. They're leaving all these business unfriendly places. Okay, Evan, let me wrap it up because we talked about it. Let me wrap up tonight's session with something good, okay? I did it once before on a live stream, I think. Maybe. And I've done it definitely on some live conferences when we used to do live stuff more often. And that is the reluctant investor's lament. So let me get this in front of me. I've almost memorized this thing, but I always like to just have it in front of me just in case. So folks, you can get a copy of this great work that is from a very smart gentleman named Donald Wheel, who has passed on, but he wrote this back in 1977. And one of our clients actually bought me a book of all of his poems, and they're great. He was a real estate broker in New York. And what he's talking about here is his regrets, okay? His regrets of not investing. Remember what I said earlier tonight. I said that, the deals always seem expensive when you buy them or when you're looking. They're like, oh, there's no inventory and it's all so expensive. I'm just going to wait for it to crash. And then it never does. And you just get left out, right? Or if it does, the payment is actually higher because the interest rates went up. And that's the reason the market crashed, right? So it's that blend. It's not about the price. It's about the monthly cost of ownership, okay? So he wrote this great poem back in 1977. This is something you should listen to every day. You should get a copy of this from one of our investment counselors, paste it on your bathroom mirror, and read it every morning. Here goes. I hesitate to make a list of all the countless deals I've missed, bonanzas that were in my grip, but I watched them through my fingers slip. The windfalls which I should have bought were lost because I overthought. I thought of this, I thought of that. I could have sworn I smelled a rat. And while I thought things over twice, another grabbed them at the price. It seems I always hesitate, then make up my mind when it's much too late. A very cautious man am I, and that is why I never buy. When Tucson was cheap desert land, I could have had a heap of sand. When Phoenix was the place to buy, I thought the climate was much too dry. Now, just so you know, before I go on, I've truncated this a little bit. It's actually longer. It's such a masterpiece. So I've kind of shortened it a little bit. Continuing here, he says, invest in Dallas. That's the spot. But my sixth sense warned me I should not. And that is why I never buy. How Nassau, how Suffolk grew, North Jersey, Staten Island too. When others called those sprawling farms and welcome deals with open arms, a corner here, 10 acres there, compounding values year by year. I chose to think, and as I thought, they bought the deals I should have bought. The golden chances I had then are lost and will not come again. For today, I cannot be enticed, for everything in 1977 is so overpriced. The deals of yesteryear are dead, the market's soft and so's my head. At times a teardrop drowns my eye for the deals I had but did not buy. And now life's saddest words I pen, if only I'd invested back then. That's it, folks.
Amen.
That is the lesson you do not want to learn. Okay. So
right.
Do not learn that lesson. Learn it from him, learn it from his experience. And as the old saying goes, don't wait to buy real estate and then wait. Thanks to everybody who joined us. One favor I've got to ask of you before you go, folks, smash the like button. Click like. I can see how many people are on here watching, so I'll know if you click the like button. Click the like button, go back and review this. Check out the podcast, The Creating Wealth Show. And of course, join us Monday, Wednesday, Friday for new Creating Wealth shows. We broadcast every Monday, Wednesday, Friday. And the YouTube channel as well has great resources. Evan is available for you. He's one of our great investment counselors, and we've got a whole team of them. So they're all available for you at jasonhartman.com. Also, I didn't mention, you can get a free book. It's scrolling across the bottom of the screen at pandemicinvesting.com that addresses some of the issues specific to investing in a pandemic in these times. So that is a free mini book, and it's there for you at pandemicinvesting.com. No credit card, it's no shipping. It's just totally free. It'll be emailed right to you when you sign up. Thanks again, everybody, and happy investing. Thank you, Evan.
Happy investing.
Bye.
Bye, everyone.